Welcome to Module 11 of Accounting 5000. In Module 11, what we're going to do is the first part of Chapter 6. We're going to talk about land, buildings, equipment, and depreciation. So we'll go back probably down through about page 194 of your textbook. In Module 12, we'll pick up the rest of Chapter 6. So in this module, let's talk a little bit about land first, because land is the first thing that most companies buy when they're getting ready to develop a project, for example, to build an office building or to put up a manufacturing plant. When you are buying land, remember we use historical costs as our basis for entering that transaction into our records. So we include the cost of the land plus any costs that we incur to get that land in place ready to use. So if we have to clear it, we have to bulldoze it, those items all go into the cost of the land. If it's for an investment, then remember that we're not going to put it as an asset under our operating assets. We're going to put it down at the very bottom of our balance sheet asset accounts as a non-operating asset. But typically we buy land because we're going to put something on it, something that we're going to use in our business, either an office building or a manufacturing plant or storage facility of some kind. In that case, it's included with our equipment and our buildings up in the top part of the long-term assets. The one thing you need to remember about land is that it is unlike building and equipment. Building and equipment are depreciated. Land is not depreciated. Land is never used up, in theory, so it at least retains its value, if not increases in value over time. If it increases in value over time, we will have a gain when we sell it. If it decreases over time, we will have a loss. But with the scarcity of land, remember that's a set amount of land in the universe, it's very unlikely that land will actually reduce in value. So typically when we sell land, we have a gain. So land is shown in our books at cost, what it costs us to put it in place ready to use, and we do not depreciate it. The next item that you see under long-term assets will be buildings and equipment. Buildings and equipment, again, are put on your books at original cost, and anything it takes you to get them in place ready to use. So if you're buying a building and you have to pay broker's fees to purchase the building, or if you have to do something in additional to get the building ready to use, those are all costs of the building. The same is true with equipment. If you purchase equipment and you have to pay insurance to get the equipment transported to your place of business, that's a cost of the equipment. If you have to set up the equipment and run some tests through it, that's a cost of the equipment. So the key phrase there is anything it takes to get the equipment or building in place, ready to use. That goes into the cost. Now, unlike land, buildings and equipment tend to decrease through the time of its useful life. So typically what we do, we call those depreciation expenses. And a depreciation expense is when we try to match the revenue that the building or equipment generates with the value of that equipment that declines over time. That's a matching idea, matching the revenues with the expenses that produce that revenue. Really all we do in accounting is allocate the cost. There are two different kinds of depreciation. There's economic depreciation and there's accounting depreciation. In economic depreciation, what we look at is how the value of an asset decreased. In accounting, what we're looking at is allocating the cost of the asset over its useful life. So when we talk about the fact that when you buy a new car and it depreciates the minute you drive it off the lot, that is an economic depreciation. That's not an allocation of cost, that's a decline in value. So we need to look at the two different aspects, and remember that in accounting, all we're doing is allocating the cost of that equipment to an expense account to offset the revenues that that equipment or that building or other asset is producing. Now what we run into in accounting lots of times is the fact that when we purchase things, we purchase a group of them together. And that's called a market purchase or a basket purchase or a market basket purchase. In this case, what we're doing is buying a bunch of assets and paying one amount for them. And we have to allocate that one amount among the various items that we purchased. Now there's a good example of that in your book in the box on page 189. Notice that we need two pieces of information. We need the appraised value of the items that you purchased, and you simply total those up. And then you need the purchase amount for all the assets. All you're doing in that case is taking the relative piece that each asset has of the total appraised value and taking that percentage times the cost, or what you paid for that equipment. If you'll look in the book on page 189 in that box, it will show you the steps that you go through. Additionally, in a few minutes, we'll work a problem that shows you those steps again, and you'll get to work through it for yourself. Typically, this is used in a company when they buy a land and building together for one set amount and they have to allocate the cost between the land and the building. Or when a company buys a land and the building has equipment in it, and they have to allocate the cost among the land, the building, and the equipment. So it's a fairly common event in businesses' economic transactions to purchase more than one item for one set amount, and then have to allocate that purchase price among various assets so that they can get a realistic picture of the cost of each asset and how to depreciate each of those assets. Now remember, we talked about depreciation being the allocation of cost in accounting. And in your book, they talk about 4 specific types of depreciation methods. We can pick any one of these methods to use in our accounting procedures as long as we're consistent in the way we use them. And we can use different accounting depreciation methods for different assets. For example, we could use one accounting method of depreciation for our building and another for the equipment. It just depends upon the desires of the owners and managers of the company as to what is the most realistic method to use for each asset that they're using. When you take the cost of an asset and you subtract out all the depreciation that you've had for the life of the asset, the difference between the cost and that accumulated depreciation is called net book value. All net book value is the cost of the asset minus all the depreciation you've taken over the life of that asset. We take all of those asset depreciation values, we add them together, and we call that accumulated depreciation, because all it is the sum of the depreciations. Accumulated depreciation is shown on your balance sheet as a negative amount to the asset. For example, if you'd been depreciating your equipment, on your balance sheet it would show you the cost of the equipment less the accumulated depreciation for that equipment, and it would come up with a net book value for that equipment, which would simply be the cost minus the accumulated depreciation. Each year when we record our depreciation for an asset, our journal entry is to debit depreciation expense, because that's the using up of the value of the asset, the cost of the asset, over the life. So that's an expense that we're going to match with our revenues. So we debit depreciation expense, and we credit that accumulated depreciation account. So we're increasing that accumulated depreciation over the life of the asset. That entry, you will notice, does not have any debit or credit to cash. It's simply a debit to depreciation expense and a credit to accumulated depreciation. Now, as we said before, there are 4 different methods of depreciation that are talked about in your textbook. There's straight-line depreciation, units of production depreciation, sum of the year's digits depreciation, and declining balance depreciation. If you look on your textbook on page 192, and it continues over to the top of page 193, there's a description of the different methods of computing depreciation using those 4 different types of depreciation methods. For example, straight-line depreciation is exactly what it sounds like. You take the same amount of depreciation each year. Units of production method, though, you take a different amount of depreciation depending upon how much you use the asset. For example, if you determined that a car was going to be depreciated based on the mileage each year. If you did 10,000 miles one year, you might have $5,000 of depreciation. Then if you did 15,000 miles the next year, you might have $7,500 worth of depreciation. So the units of production depreciation method depends on the use of the asset for that particular year. A sum of the years digits method is really an interesting method in which you take the total number of years that the asset is going to be useful to the firm, what we call the useful life, and you add up all the numbers below that. For example, if you had a 3-year useful life asset, you would add up 3 plus 2 plus 1, and you would get 6. In the first year of your depreciation life, you would take the 3, divide it by the total, which is 6, and multiply it by your asset cost minus salvage value. The next year you would do 2/6, and last year you would do 1/6. So that's kind of an interesting method. It's an accelerated method. In other words, it gives you more depreciation at the beginning of the life of the asset than does straight line, but it doesn't have an equal amount each year because at the end you're taking less than you would under straight line depreciation. The last method they talk about in your book is called a declining balance method. The one we use in accounting most often is called double declining balance. And what you do in double declining balance is take 100%, you divide it by the number of years of useful life. Let's say it's a 4-year life. You would take 100% and divide it by 4, and you will get 25%. The double amount means that you're going to double that 25% to 50%. And you're going to multiply that 50% times the cost. The interesting thing about the double declining balance method is that each year you take cost minus any previous depreciation that you've taken times that percentage, that double percentage amount. Again, we'll demonstrate those in just a minute, but there's a good example of those methods in your book on pages 192, continuing to the top of page 193. In order to work those problems, you need to understand some terms. So let's talk about each of the terms that's used in depreciation so that when I say those in the next couple of problems that we work, you have an understanding of what I'm talking about. The first item you need to know is cost. And cost, like we said previously, is simply the amount that you purchase the item for plus anything that you have to incur to get it in place ready to use. The next thing you need to know is the first item on the slide that's in front of you, which is salvage value. This is an estimated amount that the asset will be worth when its useful life is up. What will it be worth when you've used it as much as you're going to use it? That's salvage value. The estimated life is an estimate by the accountants and managers as to how long that particular asset will be useful. Typically, for example, a car might have a 5-year useful life. A computer, on the other hand, may have a 3-year useful life. A building could have anywhere from 20 to 40 years of useful life. The last thing that you need to know that's on that slide is that we have special depreciation methods that we use for tax purposes. The previous depreciation methods we talked about, straight line, units of production, declining balance, and some of the year's digits, are used for financial reporting purposes. The tax law, however, has its own methods of depreciation, which are called ACRS and MACRS, often used by accountants as acres and makers. The current tax law has us using MACRS, MACRS, which is a modified accelerated cost recovery system. There are charts that the IRS provides that tell you exactly what percent of the cost minus salvage value of an asset that you can use each year for tax purposes. We're not going to get into how you actually do that in this class because we're focusing mainly on financial accounting and managerial accounting. We're not looking at tax accounting. But if you're interested in this, you may want to get a pamphlet that the IRS produces called Depreciation, and you can look up the different charts that it has for how you compute MACRS depreciation for tax purposes. But like I said, in here we're not going to concern ourselves with it. Just be familiar with it, because as you get in your firm and they start talking about tax depreciation, you will want to realize that that's different from what we use for financial purposes. Well, let's practice a little bit of financial accounting depreciation then. Let's look at problem 2 in chapter 6. Problem 2 is at the bottom of page 215 of your textbook. And in this problem, we're going to allocate a bunch of assets which we purchased for one price, called a basket purchase allocation. Crow Company purchased some machinery in a liquidation sale. It cost them $8,400. They had to move that equipment and install it in their place of business, and that cost them another $800. So the total cost of the equipment would be the $8,400 plus the $800 to get it in place. So the total cost would be $9,200. Now in that chart on the problem, they give you the 3 different items that they purchased: a punch press, a lathe, and a welder. They give you the net book value on the date of sale that's on the seller's books. You don't need that information. That's just to confuse you, so ignore that. They give you the list price of the same item if they bought it new. You don't need that either. Again, that's just to confuse you. What you do need is the last column there, which is the appraised value of the equipment. In other words, what the fair market value of that equipment would be: $6,000, $3,000, and $1,000. So in part A, they ask you to calculate the amount that would be recorded for all of the pieces of equipment. Well, like we said, that would be the $8,400 plus the $800 it costs you to put it in place, or $9,200. In part B, they ask you which of the following alternatives should be used as the depreciable life for their depreciation calculation, and explain your answer. The remaining useful life to the seller. Well, that doesn't have any value to you, what the seller was going to use it for. You're only interested in your books. The life of a new machine. Well, these aren't new machines, so they're not that's not a useful piece of information to you. And finally, the useful life to you of that asset, that's what you're going to use. How long would you be able to use that asset? That's the piece of information you need in order to depreciate the equipment. They want us to calculate the amount that would be recorded for the cost of each of these assets. So what we're going to do is take the $9,200 and divide it up among those 3 assets. We're going to do it based on the appraised value. So remember, there was a $6,000, a $3,000, and a $1,000 appraised value for a total of $10,000. So the punch press had a $6,000 appraised value. There was a $10,000 total value for all of the appraised values. So that's 60%. So the punch press, being the first item, would get 60% of $9,200, which would be $5,520. The lathe was a $3,000 appraised value out of the $10,000 total purchase amount. So it would get 30% of the $9,200, which would be $2,760. And then finally, the welder was $1,000 of the $10,000 appraised value. So you would take $1,000 in relation to $10,000, which would be 10%, times your $9,200, which would be $920. So that's how you go about doing an allocation among the various amounts of assets that you purchase for one price. Now let's practice some depreciation methods. And let's use problem 8 as our example. Problem 8 is about a third of the way down page 217 of your textbook. You have a company that's acquired a new delivery truck. The truck costs them $26,000. The estimated life is 4 years, and they expect it to be worth about $4,000 when they're through using it. So they ask you to calculate depreciation for each of the 3 different methods they list there. Straight line depreciation. Okay, here's the calculation for straight line depreciation. You take the cost of the asset, you subtract out the salvage value, and you divide that remainder by the number of years of useful life. So it's cost of $26,000 minus salvage value of $4,000 divided by the number of years of useful life of 4. That would give you $5,500 each year for 4 years. In the second one, they ask us to do sum of the years depreciation. Well, it's a 4-year useful life, so we add up all the numbers from 4 down. 4 plus 3 plus 2 plus 1. That will give us 10. So the calculation for some of the year's digits is to take your cost of $26,000, subtract your salvage value of $4,000, then multiply it by the first number, which is 4, divided by the sum, which is 10, which is 4/10, and that gives you $8,800 for the first year. The second year, you would take your $26,000 cost, subtract out your salvage value of $4,000, and this time you multiply it by the second number, which is 3, over the sum, which is 10, and that would give you $6,600. The third year, you take the third number, which is the 2 over 10 times cost of $26,000 minus salvage value of $4,000, which would give you $4,400. In the last year, you would take your cost of $26,000, subtract out your $4,000 salvage value, and multiply that by your last number over your sum, which is 1 over 10, and that would give you $2,200. The next one is the double declining balance method. In the first step of this method, you take 100%, you divide it by the number of years of useful life, which in this case is 4, and that will give you 25%. Since it's double declining balance, you double the 25%, and that gives you 50%. Notice that the first year, what you do is you take your cost, multiply it by the 50%. That gives you $13,000. The key to the double declining balance method is that you do not use salvage value. You use salvage value in straight line, you use salvage value in units of production, you use salvage value in the sum of the year's digits. But in the double declining balance, you do not use salvage value. You simply take cost minus the accumulated depreciation times your computed double percentage. The first year there is no accumulated depreciation, so you take cost minus 0, or $26,000 minus 0 times 50%, which gives you $13,000. Now notice on the next line, in the second year you take the $26,000 minus all the depreciation you've taken so far. Well, there's only 1 year, so it's $13,000 times your 50% gives you $6,500. In the third year, you take your $26,000 minus all the depreciation you've taken so far, which is $13,000 and $6,500. You multiply that by 50%, and that should give you $3,250. Now, the key to the double declining balance method is you never want to have more accumulated depreciation than cost minus salvage value. So think a minute. Cost is $26,000. Salvage value is $4,000. So we never want to have accumulated depreciation of more than $22,000. Well, if we add up the accumulated depreciation we have in year 1, $13,000, plus year 2, $6,500, that gives us $19,500. So the most we can take in the third year is the amount that it would give us from $19,500 up to $22,000, which would be $2,500. So the most we can take in year 3, although we computed $3,250, is $2,500. In year 4, even though it's a 4-year property, we would not be able to take any salvage value because any depreciation, because we've already used up the depreciable amount. We took $13,000 in year 1, $6,500 in year 2, $2,500 in year 3, so that's our total of $22,000, so we cannot go any further in year 4. So that's the trick to double declining balance. Never take more than cost minus salvage value as your total depreciation. Finally, in the Part B, they ask you to calculate the truck's net book value at the end of the third year under each depreciation method. What we would do in that case is take the cost minus all the accumulated depreciation we've taken for 3 years and subtract that from the cost, and we would have our net book value. So under the straight line method, we would have the $26,000 cost minus the 3 years that we took $5,500. Remember, each year is the same under the straight line method. So cost minus 3 times $5,500 would leave us with $9,500. Under the sum of the years digits method, we would take the cost of $26,000 and subtract out the 3 years of accumulated depreciation, which would be $8,800, $6,600, and $4,400, which would leave us with $6,200. And finally, under the double declining balance method, we would take the $26,000 minus the $13,000, the $6,500, and the $2,500, and that would leave us with $4,000. In Part C, it says assume that the company had no more use for the truck at the end of the 3rd year, and at the beginning of the 4th year it had an offer from a buyer who was willing to pay $6,200 for it. Should the depreciation method that they used affect their decision to sell the truck? No. The depreciation method is simply a way of allocating cost. Their decision to sell the truck would be based on how much they expect to use that truck. In other words, what's the value to them in relation to the $6,500 they were offered. Depreciation method has nothing to do with how they would sell it, or whether they would sell it, or how much they would sell it for. So that was a good example of going through and doing various methods of depreciation. Remember, there's an example in your book, and this is a good example of a problem that you've worked using depreciation method. Let's look at how this depreciation idea appears on financial statements by looking at problem 22 in your textbook. Problem 22 is near the top of page 223. And what they've done here is given you a balance sheet for a company showing the machine, and they've given you the accumulated depreciation amounts there in the topic, $31,500 for 2004 and $22,500 for 2003. And they're showing you the net book value over on the right-hand columns. For December 31, 2004, the net book value was $40,500, and the net book value at December 31, 2003 was $49,500. In Part A, they say if there had not been any purchases, sales, or other transactions affecting this equipment, what is the amount of the depreciation expense for 2004? Well, the amount of depreciation expense would simply be the difference between the depreciation that was accumulated as of 2003 and the accumulated depreciation in 2004. Well, the 2004 amount is $31,500, and the accumulated depreciation amount in 2003 is $22,500. So the difference between those two amounts is $9,000. In Part B, it says to assume the same facts in A and assume that the estimated useful life is 8 years and there's no estimated salvage value. What was the original cost of the equipment? Well, we can take that by taking the net book value in 2004, which is $40,500, and adding to it the accumulated depreciation amount, and that should give us the cost of the equipment. That's just a variation of the formula that cost minus accumulated depreciation gives you net book value. So if we add the $40,500, the $31,500, we get $72,000. Now we could have done the same thing using 2003 simply by taking $49,500 net book value and adding the $22,500 accumulated depreciation, and we would still end up with $72,000 in cost. So we know we're right because we can check it that way. In letter B, it asks you what depreciation method is apparently being used. Well, if you know it has an 8-year useful life and you know the cost is $72,000, the straight line method would simply be taking the cost, dividing it by the years of useful life. So if you take $72,000 and divide it by 8, you get $9,000, which is exactly the amount we got for the amount of depreciation that we're taking each year. So it appears that we're taking straight line depreciation. Finally, in Part 3 of letter B, it says, when was the equipment acquired? Well, if in 2004, the end of 2004, we have a total of $31,500 in accumulated depreciation, and we're taking $9,000 a year, if we take the $31,500 and divide it by the $9,000, we find that we've taken 3.5 years worth of depreciation. Well, 3.5 years from 2004 means that we bought it in the middle of 2001, because we would have taken a half a year in 2001, a whole year in 2002, a whole year in 2003, and a whole year in 2004, which would give us 3.5 years. Finally, in Part C, it says, assume that this equipment account represents the cost of 10 identical machines. Calculate the gain or loss on the sale of one of the machines on January 2nd, 2005, if they sold it for $4,500. One of the machines, there are 10 of them, so that would be 1/10 of the cost. So 1/10 of $72,000 means that one machine costs $7,200. The accumulated depreciation is 1/10 of the accumulated depreciation so far. Remember, it's $31,500 at the end of 2004. So we have accumulated depreciation of $3,150. So our net book value for one piece of equipment is the cost of $7,200 minus the accumulated depreciation of $3,150, or $4,050. That's what it's on our books for, one piece of equipment. Well, if we turn around and sell that equipment for $4,500, we're going to have a gain of $450. That $450 is the excess we receive over book value. Now, if the book value were $4,050 and we sold it for $4,000, we would have a loss because we were receiving less than the net book value of that equipment. So bear in mind, it could be less if we receive less than book value. It would be a gain if we receive more than the book value. So those problems should help you a little bit understand land, equipment, and buildings, the depreciation, and the purchase of groups of buildings, land, and equipment, how to allocate those costs. In the next module, we're going to continue with this chapter and talk about some other long-term assets.